Hi everyone, Brindley here, joined again with Richard to give you another daily dose of development tips, insights, and some information to help you start or scale your property development business. And today, what we wanted to talk about, there's the whole phrase I guess a lot of people know is start with the end in mind. And obviously, through the development life cycle, the development process, the end is of the seven stages is exit, but we need to have a clear sort of understanding of what our exit looks like. And ultimately, before we get into the details of strategies to determine your exit, you build to sell, build to hold, and all the kind of fineries within those kind of elements, we need to take a step back and we need to look at your business planning, really. So it's working out what your aspirations are and what you're looking to achieve, and then planning your business accordingly, working out what operations that you need to do and the sort of things you need to actions you need to take within your business that are going to help you achieve your objectives. So we thought we'd share with you just some insights really into how we go about it and what some things to consider. The great thing about understanding the development business as a whole is that if you can understand the fundamentals, then you stick to those fundamentals no matter what you're looking to achieve, whether you're looking to achieve short-term, medium-term, long-term outcomes, whether you're looking to build up capital, whether you're looking to build assets, whatever it is, that generally the kind of steps through the process are the same, which puts you in a good position in terms of being able to move with the market and be flexible. So we're going to look at a few different sort of elements really, and I've touched upon a couple just there. Development as a general rule is a very capital intensive business. That being said, it can also produce a lot of capital. You can make a lot of money doing development. You can lose a lot of money doing development if you get it wrong, obviously. But I think that's the allure for a lot of people to kind of move through the gears, whether you're in property or business at the moment, and ultimately hit the pinnacle, or what seemingly is the pinnacle of developing property, new build property, whatever that may be, because of the amount of money that you can make. We've talked in previous videos about risk and how to mitigate risk, and if you can look after the risks, the rewards will look after themselves, and you will be able to make a lot of money and make a lot of a difference in the world. But effectively, you've got two routes that you can go down, and it's not one or the other. It's kind of what you gravitate towards, but also having an eye on other ways of making money and shoring up your business along the way. So first of all, you either are attracted to development to build as a vehicle to build up capital. So first of all, there's build capital. And second of all, there's build assets. So looking at the exits, you're either looking at a build to sell trade strategy, or you're looking at a build to hold strategy to hold properties that you've created for long-term income generation. So first of all, you've got to ask yourself the question, well, what's my primary? And I wouldn't say going into the business with just your mind set on one or the other is the right thing to do, but you should certainly have your kind of eyes on a primary sort of exit that what you're looking to achieve, and that might be in alignment with your overall aspirations as a developer. Some developers want to get into this game and grow their business to the extent that they just want to leave a big legacy for future generations. Other people want to build empires. We've dealt with developers that have been coined developers of the decade, building millions and millions of square foot of residential, commercial, really changing the way the areas are and placemaking. We've also dealt with other people that just want to take it step by step, sort of build up from sort of almost a humble beginning, really 1-2 units, and then sort of take it step by step to building a nice kind of almost kind of a lifestyle type size business where you're not absolutely banging the drum and going hell for leather as if you were trying to, produce thousands of units a year. But if you're looking to produce 20 units a year, obviously there's a lot of involvement in that, but it's something that perhaps you could manage and you could maintain over a period of time. So going out there and putting your business plan together, it is directly related to what you're looking to achieve. And you kind of I want to kind of highlight that with a kind of, there's no point climbing a ladder if your ladder's leaning against the wrong wall. We see a lot of people going out there, spending a lot of time, money, energy, sourcing loads of deals or trying to gain loads of investors and all that kind of stuff, when in reality you strip it back and it's not really what they want to do in the long term. They think it's kind of like a means to an end. One of the main things I will say is that development as an industry isn't, in my opinion, isn't an industry or a business model that you should be getting involved in unless you have a background income, or you have you've got an income coming in from somewhere that pays your bills. You don't want to get into the scenario where you're looking for the next deal and just to keep the roof over your head, for example, because that's when your mind can drift and you can start getting involved in questionable projects, should we say. But I'll hand over to Richard, get his sort of thoughts really on where to start and how to align yourself really with what you're looking to achieve.
Yeah, so I guess what I'd add to that really is in terms of the two exits, if you like, the hold or the sell. I think that there are if you don't have a clear idea of where you're heading, so we get a lot of people that build to sell. We get quite a lot of people that are just build to hold. They're not going to get rid of anything. But what you need to consider is, are you building to hold to sell? So how long are you looking to hold? So that's a really, really important thing. So we, as Ben has alluded to before, is we, as a business, we've always been traders, and it's only in recent times that we've looked and dabbled a little bit with holding, etc. We are now currently that has changed, because a lot of what he's done is for legacy in many ways. So legacy really is not short term; it's long term. So we are building to hold, full stop. Not building to hold to sell to fund a retirement or anything like that, because unfortunately a lot of people come unstuck there. Because if you're building to hold and then you're going to sell, if you were selling at the wrong time, like in the period of great uncertainty, maybe you've built up a lot of a lot of value in your property sort of empire, your property portfolio, but actually you're going to probably be selling it at the wrong time. So it is quite important to be relatively clear. But then I'll contradict that by saying, actually, you've got to be agile, you've got to be flexible, because as market conditions change, then if you are adopting one strategy only, as again Bryn mentioned previously, that's quite dangerous, because if you have a mindset that I never sell property, you might be missing on opportunities to actually cash in, get a lot of money together so that you can go again. And equally, if you're only working on a build to sell, then you're going to miss out, because you will be much more subjected to the economy and the market conditions, etc. So yeah, for us things change, and as always been a trader, my mindset has been as a trader, and it still is, if I'm perfectly honest. It's only working with people around me that are more long-term focused that I see some of the attractions of hold. I still do not see the same amount of attractions that many people I talk to, and that's because they don't have a trading mindset. So it's important to try and get that balance, but actually it does turn out that you're sort of one or the other. So if you have business partners or people that you rely on, you want to make sure that they give you some balance. So particularly in sticky times, where we might sit in an uncertain market, we have projects that say actually we started a project, and 3 years later, because as again it's been mentioned, these are long-term Development is long term, whether you're building to hold or building to sell. It's long term. So in 3 years, 4 years, 5 years, which often these projects are, market conditions change. So actually, you need to be flexible. You need to be agile. You need to have the ability to do both. So when you are initially looking at stuff, it really should have, two eyes on it to a degree, working both ways, holding or selling. But as I say, the important difference there that I've added is the build to hold to sell. That is something different. I think we'll probably do a session at some point purely on that.
Yeah, I think that's a good distinction, really, because without that, and without the mention of that, it becomes very linear, very black or white. We're either holding property for the real long term, never going to sell it type mindset, or we're going to sell it straight away. Whereas actually, it could be a kind of a loose plan, if you like, to go, well, we're going to develop these properties. And depending on what market conditions are, if market conditions rise by a certain percentage, for example, or during the next boom period, we might look to offload our assets, because then we can produce capital, which might be useful in a bust period or a downturn. So you've got to align your operations and your actions with what you're looking to achieve. But as Richard said, not be so rigid enough that you become blinkered and you're just looking for certain sizes of projects, certain types of projects that are going to fit a certain exit strategy. Because at the end of the day, where the steps of the process in order to find, appraise, secure development projects, whether you're looking to buy them to and build them to sell or hold, are pretty much the same kind of steps. There's obviously iterations within the appraisal process, in terms of looking at the numbers of yields and life cycle costing and all that kind of stuff. But ultimately, you want to be in a position where your processes in your business model is conducive to being able to make a choice on what you do a little bit further down the line. And that could be dependent on market conditions, but it also could be dependent on how you're feeling and your business partner, if you've got one, are feeling at that point, and your need at that point as well. Because you might get to a stage where ideally you want your primary exit was to hold, and you built up a decent portfolio of, say, 20 properties over a period of time through building to hold. But actually now you're not that liquid, you haven't got that much capital to utilize, and something like, I don't know, a global pandemic comes along, you have problems with tenants and all that kind of stuff, or and it makes you realize that actually you do need to have a little bit more liquidity if something was to happen again. So you might then, your mindset might change to sort of say, well, actually I need to maintain a bit of liquidity, but I do want to still press forward with holding and building a portfolio, because it's going to generate me income on a recurring revenue basis, and then it's also something that perhaps can go towards a legacy. So ultimately, you want to get to the stage where you are looking at ways of producing short-term, medium-term, and long-term capital through the same kind of business operations. So if that's finding projects, you could then look to sell them on, package them up, sell them on to somebody else. Taking that a step forward, you could find a project, add value, and get a planning uplift, and then sell that on to a developer. So you've added significant value, and you've got a better return on your investment in terms of your time and money. Or you take it all the way to, you build out, you find the project, you add the planning uplift, you build out yourself, and then you can either sell or retain the units. So you want to try and work in and around those kind of four steps, really.
I think what one of the things people do have to consider is income. and also timescales. So yeah, I don't know what the average is, to be fair, but I can't see any of the projects we've ever worked on from inception to completion, cashing out in one way or another, is ever less than 2 years, even on relatively small projects. So typically I think now a lot of the stuff we're involved with, which is perhaps a little bit bigger, we're 4, 5 and 6 years probably from start all the way through. So it is important that you have an income. When you've been a trader all your life, then actually you're really you're living off previous profits. But then of course if you get a downturn and there aren't any profits, what are you living off of? So sometimes I just wonder how ever paid the bills. But anyway, that's by the by. But it's being realistic about timescales. So you may well have an urge to develop property and keep it all, but actually, what is going to pay? What is going to pay your bills? So you've got to look at you've got to look at funding a business, not just a project. So and a good way of doing that is have alternative incomes or background incomes. So really that sort of says be realistic with what resources that you have at your disposal, or whether you've got them directly or you can get hold of them working with other people, collaboration, partnering, etc. Because resources are key here. People underestimate the amount of money that you need to invest in even finding a deal. You'll look at a lot of opportunities before you find something that is viable, and it's amazing the amount of time and money that you do have to put into that. So again, if you're starting off and you want to get into development and you want to build a 4-unit project or a 4-unit conversion, if you haven't got any cash and you haven't got any income, how are you going to survive for all that amount of time? It could be a quick project and it's all over in 18 months. It's great, but you're taking on a lot of risk. You're relying on everything turning out well, and you're relying on making a profit in some form or other. And if you're holding the properties, well, actually, most of your profit's going to stay in there as equity. So you're not going to draw any money. So, everything, if you sort of put it in a bag and shake it all up, whether it's, whatever resources that you've actually got available, I guess it won't be enough, is what I'm actually going to say, say to fund a sustainable development business where you might have an aim of 20 units a year. It might be 200 units. It might be 4 units. You have to have that resource in order to actually meet that, so it's great to be positive and say, I aim to do 20 units a year. 20 units a year is nearly half a week. Now, if that's a house, that's a lot of work, and so who's going to do all that work? So if you are going to have people coming in to do it, so you're going to leverage your time effectively. So you're going to have project managers and all the professionals that you might need. So what is it you're actually going to do? And if you're not doing it, you're paying somebody else to do it. So you will need bigger resources. You will need deeper pockets. So where we see people make the most success is where they get on site and they do it themselves. They don't always know what they're doing, 'tis true, and they do make mistakes, but they're keeping the costs down. As soon as you start employing people, might make a better job, but actually, unless you've got the money, where's it coming from? Don't spend the profits on a project before you've realized them, before they're crystallized. Because if you're selling it, obviously you're going to get less money coming out. But if you're keeping it, you might find that the profit margin you needed in order to have no money left in, which seems to be the holy grail for a lot of people, you won't have it, because you'll then have to top it up with some equity from somewhere else. That then means that'll impact on any other projects you do. And we see it time and time again. Not just with new developers, but with scaling developers. They underestimate the amount of resource that they actually need to achieve what their goals are. So we're talking here about what the exit is, and it's nothing wrong with having big goals and stuff. No, absolutely nothing wrong with that, but they've got to be realistic. They've got to be deliverable. They've got to be achievable. So resources are absolutely key. And I think our sort of last couple of bits from me really is development. We used to sort of say it's a get rich slowly business, but actually it's build wealth slowly. Whether that is in lumps or whether that is in increased income on a monthly or quarterly or yearly basis, that's what it is. So don't be unrealistic in what timescales are involved in actually delivering projects, delivering a return. And also not just for you, but if you've got investors or you are an investor, don't be unrealistic about the timescales involved. So this is build wealth slowly. It really isn't, get rich quick, because the people that get rich quick, and you can do, don't get me wrong, they tend to also get poor quick as well. Particularly when the market turns. But so for me, last word for me really is you need some clarity, but at the same time you need to be agile as well. So I'll leave you to finish that one off, Brent.
Ultimately, it's approaching it methodically, isn't it? At the end of the day, it's approaching your business and your operations within your development business with a method, but it's also approaching the managing your wealth and building your wealth methodically as well. So if that is a case of maintaining that you do have a cash buffer, for example, if you've got a personal cash buffer of X amount of months worth of income that you never touch, you don't invest all of your available liquidity into your development business or into your business, because you're taking a lot of risk. It's always can you build in buffers along the way? If income is the ultimate goal on a regular basis, then consider whether development is the right vehicle to get you there. I'm not saying it is or it isn't, because it still could be the right vehicle, but it might take you longer to produce that regular income because of the timescales involved. So if it's a quicker regular income just to shore up your salary, then perhaps you need to look at a different business model, and before moving on to development, which is obviously a bit longer and a bit more capital intensive. The alternative way of looking at it is that if you are using development as a way of producing capital, and then using that capital to produce income, using that cash pot to invest and diversify your portfolio, for example, investing in other asset classes, whether that be stock, shares, precious metals, forex, whatever it is, other businesses, startup companies, investing in bonds and funds and all this kind of stuff. Ultimately, is that going to be a better route for you to produce the income that you need and also the capital that you need as well? Like for me, building to hold is something that I do want to do, because I want to build something of long term. It's not something that we've done. As Richard said, we've always been traders, and it's only recent that we switched our mindset to a degree to a bit more longer term outlook on things. But that being said, it's not the be all and end all. If it's appropriate to sell at any given point, then we'll look to sell. But that being said, we're not stacking deals so we can keep all of the units, for example, on a development that's going to be highly geared. If you're doing your numbers and you're gearing up to 80% loan to value, for example, because that's what you can get a commercial loan at, just because you can doesn't mean you should. So it's also about how exposed you are to market conditions. For me personally, it's anything that we hold going forwards. Ultimately, the long-term goal is 50 to 60% loan to value, because I see that as quite good debt, because it's a good ratio, and that again will increase the amount of recurring revenue on a monthly basis that you get as well, obviously, because you haven't got as much borrowings, you haven't got much to pay back. So the income that you're getting from your tenants is a little bit, you get to keep a little bit more of it, all being well. So if that involves, say, on a 10-unit scheme, selling, 6 of them and keeping 4 of them to keep that loan to value down, or selling 8 of them to keep 2 of them to keep that loan to value down, then that's something that we seriously consider, rather than keeping 6, 7, 8 of them at high gearing. So there's lots of different dimensions to your exit strategy, but ultimately it comes down to what you are looking to achieve long term. And as I said earlier, make sure that your ladder's leaning up against the right wall to start with. So hopefully that's given you some food for thought. If you've got any questions off the back of that regarding your business planning, how we potentially can help you, then get in touch with us. Write some questions on our Facebook group, or get in touch with us on social media wherever you're watching this, and we'll do our best to give you some more food for thought and give you some actionable steps to help you start or scale your business. So hope you found this useful. And thanks for watching, and we'll catch up with you very, very soon. Take care.
Bye.